This is where many banks invest some of their money. In this episode, I'm going to dive into the question, how safe are insurance companies? Well, it's where I put my serious cash because of the safety of these institutions. I'm going to explain why and how they weathered the Great Depression with flying colors. And this is where many banks, credit unions, even brokerage firms put a lot of their money for liquidity and safety. So get ready. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist, a tax minimization specialist for more than 46 years. I've authored 11 books so far, and my goal is to write a book every year the rest of my life. And I help people optimize their financial assets and minimize taxes. After doing this for my own clients, thousands of clients throughout America, in 2003 to 2007, I trained over 3,000 CPAs, tax attorneys, and financial advisors. In fact, my publisher, which was originally Warner Business Books under Time Warner, they estimated 50,000 plus advisors were buying my books in bulk, but sometimes they were passing them out like loose cannons, tearing out just certain chapters and then switching people, like baiting people and then switching them to their inferior investments and what have you. And so that's why I let all of my professional licenses automatically expire at the end of 2005 to become a consumer advocate. I started a radio show. I started writing more and more books. In fact, at the end of this episode, I'm going to show you how you can get my most recent best-selling book. It retails for $20, but I will gift it to you absolutely free, and you can learn more about these answers that are so critical to this question in this episode. Well, are insurance companies safe? How safe are they? So are you ready to understand really why the insurance industry is not only the backbone of America, but the backbone of the world? This is where many banks, credit unions, and brokerage firms put their money for liquidity and safety. And let me give you the history behind it with the Great Depression and 2008. Many people don't realize we came so close to a total financial collapse in America in 2008. And this is why we look at, during those critical times, where was the safest place for people to have their money? So let's go back to the Great Depression. Most of the legal reserve insurance companies, ooh, that's a new term. You're going, what's that mean? A legal reserve insurance company means that the insurance company has to have reserves on hand that are liquid and safe in case of a major run on the bank where people panic and so forth. Most insurance companies have their general account portfolio, their billions, and some of the companies I put my money into have trillions of dollars. One company, they manage about $3.5 trillion, maybe a little bit more than that now. That's as much money as the IRS collects in income taxes in an entire year. One insurance company manages that, and frankly, they manage it maybe with a skyscraper full of employees. Do you know how many federal employees it takes to manage 3.5–4 trillion of our tax dollars? I don't even want to go there, okay? But let's go back to the Great Depression. These insurance companies, they have legal reserves on hand. They diversify. They put money in AAA and AA bonds. They put it on mortgages, but only about 50% loan to value on skyscrapers and shopping malls. They protect themselves. If they ever have to foreclose on a skyscraper, they come out smelling like a rose because they don't loan 80 and 90% like banks do. So during the Great Depression, that was clear back, as you know, in the early 1900s. Many of the companies I put my money into have been around since the mid 1800s. One I was just talking about, 1848. So they've been around a long time. During the Great Depression, they came through with flying colors. Do you know in the Great Depression, some real estate dropped 80% in value? Banks closed, 40% never reopened again. Guess how many legal reserve insurance companies went under in the Great Depression? 0. Okay? They came through crediting 2.5%, 3.5%. Let's go to the next real bad time, 2008. In 2008, we were on the brink of financial collapse in America. 400 banks went under. And 900 more were on the brink, on the watch list. That's when you get worried, because even FDIC can go broke, but the government can raise taxes, they can print money and so forth. And so, most of the time people feel pretty safe with their money in a bank, even though FDIC can be drained of their resources. I like the multi-trillion-dollar insurance industry because they cross-insure each other. If an insurance company even comes close to being insolvent because of a run on the bank or something, all the other insurance companies have to ante up their pro rata share of the business they have in each individual state. And it's called cross insurance. That's why there's never been a legal reserve life insurance company ever not honor a legitimate claim. Folks, they're usually purchased by even another insurance company if it gets that bad. So in 2008, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets. That's money they have to have on hand, liquid and safe in the event of an emergency, a run on the bank where people just wanted all their money out of the bank. Guess where the banks and credit unions disclosed 30 to 40% of their Tier 1 assets was invested? In insurance companies. It's called BOLI, bank-owned life insurance. The major corporations have it in COLI, C-O-L-I, corporate-owned life insurance. That's where I have my corporate assets. Why do they do that? Are you ready? Put on your seat belt. You're going to be blown away. Now, if you've got to go and you're already curious, I want to gift you a free copy of my most recent bestseller. This is book number 11. It's called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. In here, you will learn how safe the insurance industry is, but you also have ratings. You look at Comdex scores, AM Best, Standard & Poor's, Duff & Phelps, Moody's, Weiss, all of these different rating agencies, but I simplify it and subscribe to one that gives a Comdex score. And I would recommend you put your money in an insurance company that is rated 90 or higher on the Comdex score. That means they're in the top 10%. 90% of other insurance companies are not as safe as that one. That's where I put my money for safety, as far as safety of the institution. But I like to have my money that is protecting my principal, that whatever I put into the insurance contract, the insurance policy, is protected from loss, and any year that I make money, it becomes newly protected principal. I don't want to lose in the future money I've made in previous years. That's explained in my book, The Laser Fund. It retails for $20. I will gift it to you free. You can claim your free copy by clicking on the link below. Go to laserfund.com, pay $5.95 shipping and handling, and I'll send one out to you free. But let me share with you this powerful concept. See, banks and credit unions during the last 20 years have been paying at low interest rates. I remember, 1% or less sometimes. So here's a bank or credit union borrowing our money at 1%, let's say. So there's only 4 things you can do with money: spend it, lend it, own with it, or give it away. When you have money in a bank, a credit union, or an insurance company, it's in a lended position. Are they just a benevolent institution paying you interest while it sits in a vault? No. What are they doing with your money? They're loaning it back out again or investing it. I just showed you, they'll borrow our money at 1%. They'll put it into BOLI, bank-owned life insurance contracts. Well, who's the life insurance on? Doesn't matter. It's the owner of the insurance policy. They own insurance policies on their board of directors and people and so forth. And I own policies not only on me, but my wife, my kids, my grandkids, and so forth, because the owner gets all the tax-free accumulation and tax-free income. So insurance companies borrow our money at 1%, and they earn 5, 6, 7%. Wait a minute, on $1 million, they pay us $10,000 a year in interest, but they're earning $50,000 a year in interest. How much more is 50 than 10? Don't say 40. It's 500% more. Let me say it another way. If you were an employer, would you hire an employee for $10,000 that made you an extra $50,000? Oh, yeah. Would you buy a widget machine for $10,000 that made you an extra $50,000? Yeah, that's called a 500% return on employment costs or equipment costs. you can do this. So how safe are insurance companies? Safe enough that this is where the banks and credit unions put their money. In fact, most banks maybe are only rated triple B by Standard & Poor's or Moody's or what have you. They take our money and they increase the safety by 6 notches higher to triple A in a multi-trillion-dollar insurance company, a legal reserve insurance company. They increase their safety and their rate of return by 5 times. If you haven't gotten the epiphany yet, you can bypass the middleman with your long-term savings. Why would you put your money in a bank and let them put your money over here when you can just bypass them and put your serious cash into those and have the same liquidity, safety, and rates of return that you're trying to achieve, but you're actually in a safer environment to do it? So, guess how many legal reserve life insurance companies went under in 2008? 0. They all came through with flying colors. So when people ask the question, how safe are they? Well, that's where I put my serious cash, because they would be the last domino to fall. If things got really, really bad, I would probably get sufficient notice to get my money out of my insurance policies. But where would I put it? If it's the last domino, if it's the safest place, you better be able to grow carrots in your backyard. Even gold and silver, you can't eat that. And so I put my serious cash in the legal reserve insurance industry, Diversified, for the greatest safety, and that's my take on it. If you want to learn more about this, again, claim your free copy of this 300-page book. This side is charts and graphs and explanations. This side contains 62 actual client stories. So you can learn by stories and also by the numbers, right brain, left brain. Simply go to laserfund.com, L-A-S-E-R, laserfund.com, or click on the link below. You simply pay $5.95 shipping and handling, and I'll pay for the book. You pay for the shipping. There's also options there to listen and learn or watch and learn. And this may be the beginning of an incredible opportunity to have the highest amount of safety and earn predictable rates of return totally tax-free for you.